Welcome, everyone. Henry Wheelwright, managing partner and co-founder of StablePoint Partners. It's Friday, February 28th. We hope our clients and guests are all doing well. And as we've done in the past, I want to put out a video just to get some timely information, some thoughts on the markets. Anybody who's been watching the markets, watching the news flow the last few weeks has probably felt a little anxiety. We feel like we have more volatility than we've had. And of course, the policies coming out of the new administration around trade, tariffs. We saw today a failed press conference with President Zelensky and Donald Trump. It just feels like a time where there's a little bit more anxiety and risk in the market. So I want to address a few things. Number one, we're 4.5% away from an all-time high in the S&P. And amazing as I sit here around 3 o'clock on Friday after that press conference that no doubt if you haven't seen will be over the news, the market is holding on to some gains. Probably tells a few things. Number one, from a tariff standpoint, the market has been trying to price in the reality of Donald Trump's 25% tariffs on Mexico and Canada. We've known and have been telegraphed that the additional tariffs would be coming along for China. And I think it's just a little early to see what leverage and negotiations may come out of specifically Canada and Mexico and what the impact will be to the consumer and, of course, corporate profits. The market is coming off, again, a very healthy earnings season and a healthy rotation into different sectors of the market. And I'll stress this. A lot of the pain, the areas that have experienced significant declines this last week amidst the uncertainty, have been in some of the best performing asset classes or more riskier speculative areas. At the top, of course, Bitcoin is off 25% from its all-time high, back under 80,000. Again, a very hard asset class to predict, but tends to be now a sentiment of investor risk. When people feel an appetite to take risk, Bitcoin goes up. And of course, the inverse has been true this last few weeks. We've seen technology names, to no fault of their own, have some of those great profits come out. You know, NVIDIA, which I talk a lot about because of the size and dominance in the AI story, just fell out of the $3 trillion market cap club, grew revenue by 78%, and the stock declined yesterday. I think it tells you that when you have a stock that's gone up 1,600% in 5 years and you have a backdrop of uncertainty in geopolitics, policies, tariffs, you're going to see profit taking, and people like to take profits out of some of their best performing investments. That is healthy. It's also showing up in the sectors that are doing well. Hey, if you look at your StablePoint portfolios, you may feel like the market's come down a lot and you're still up on the year. We've seen positive returns in some sectors that were really left out of the party last year. Healthcare is a great example. I talked about it about a month ago. Healthcare valuations are very low. There's a lot of reasons to own healthcare, both from innovation and free cash flow has been the best performing sector. We've also seen energy, financials, and then most recently consumer staple names have all done very well. So again, diversification, rebalancing, knowing your equity sleeve is appropriately priced, meaning our job is not to overpay, speculate, fall in love with a particular company, but understand the investment thesis, what we're paying, determine if that's reasonable, and own equities for economic growth and capital appreciation for our clients, but also to combat inflation. So let's talk about bonds. Clearly a sign that risk is also something that people are shying away from. The 10-year Treasury sits at 4.22, which is the lowest level since early December, I believe, of last year. That was closer to 4.8% just a month ago. People were concerned about deficit spending, inflation, and actually we've seen the reverse. Yields have come down. That's pushed up a lot of quality bond prices for our existing bondholders of the firm. Our diversification and reasons for owning fixed income, we talk a lot about wealth preservation, cash flow, but also for periods of time like this. So again, well-balanced, diversified portfolios that have exposure to some of those sectors that are doing well, clients that we've rebalanced and taken some profits out of growth names we love, but knew eventually that there might be a moment like this, have performed pretty well for us. And then lastly, I think we talk a lot about the StablePoint advantage, our ability as an independent private company to think public markets, private markets, alternative investments really are going to be very, very strong this year, I think. And that's going to be across a wide gamut of infrastructure, private real estate, private credit. For the clients that makes sense. Another opportunity to think about 2025 in a couple ways. Number one is I don't think a recession's happening. even with the uncertainty in the world, labor market's too strong, consumer spending is strong, sentiment has been coming down a bit, but it was at an all-time high just a few months ago. The fact of the matter is GDP numbers are going to be positive and quite positive, so recession isn't around the corner. I think tariffs have an ability to slow corporate earnings, but we'll see what is actually passed through to consumers. I've listened to a lot of CEOs. They've all been asked the same question earnings season, which is now, what's your plan for Trump tariffs? And if you listen to a lot of publicly traded companies that are exposed to Canada, Mexico, China, they've all talked about 2020 teaching them a real lesson, which is diversifying supply chains, right? Thinking about how they can share in cost increases. We just saw a producer price index reading today was not very alarming when it came to inflation. That's what it's costing these manufacturers to produce the products that ultimately may increase the prices of what you buy. And 2020 is pretty interesting because COVID taught businesses the need to spread that out. So there's been less exposure in a lot of apparel companies to China, Vietnam as an example. You're seeing less exposure in agriculture or avocados, things of that nature from Mexico to other countries. So again, tariffs aren't great. I view it as a negative for the market. I think most do, but ultimately it's way too early to say, hey, it's going to cause a recession. So I'll leave you with this on this Friday the 28th. Be patient. Be focused on your financial plan. You have a dynamic group of financial planners and advisors at StablePoint Partners, and your portfolios are very well diversified. So we'll be watching closely, and we look forward to our next discussion. Take care and have a great weekend.